Moody's has a negative outlook for banks in the Asia-Pacific region for 2020. It believes that the U.S. China trade dispute and heavy leverage from private sector is a key risk for these banks. I had a chance to speak to Alka Anbarasu of Moody's Investor Services, and I began by asking her about the rationale behind the negative outlook for the APAC banks. Listen.
I think that the weakening operating environment will negatively impact banks' asset quality and profitability. Some of the drivers, and I think there's a read-through of some of these drivers even for Indian banks, first of all, is we think that the U.S. China trade tension will negatively impact trade activity in the region and as well as impact investor confidence. We also think that rising leverage or high leverage in many countries, including India, will negatively impact banks' asset quality. And on top of this, we think that the lower for longer interest rate environment is negatively going to impact the bank's profitability. And that put together gels with our outlook, which is negative for Asia-Pacific banks for the next year.
Okay, you brought about the point of the longer rate cut cycle that we've been seeing most central banks indulge in. The RBI, for one, in its recent policy meet has maintained status quo. But what do you think the impact of these lower interest rates for a longer duration of time is going to be on the margins of some of these banks?
Sure. So when it comes to India, perhaps on profitability, our broad, if we were to look at the overall rated portfolio, we may expect that profitability will broadly remain stable or may even marginally improve for the banks. And that broadly depends on how credit costs turn out for the banks in the near term. So on one hand, the profitability of Indian banks is quite marginal in the regional context, with ROAs of generally less than 0.5% for the public sector banks, or the private sector banks have better profitability. Having said that, we do think that from a low base, perhaps profitability may marginally improve as credit costs come down, but nevertheless, the Indian banks stack up quite poorly when it comes to the regional peers.
Do you see that happening anytime soon, though, Alka? Credit costs coming down?
So on credit costs, there are a few things. So on one hand, we do think that in that legacy book or the book that was mainly more infrastructure loans, we do think that a lot of work on provisioning has been done. Generally, provisioning coverage ratio in the system is over 75% for most banks that we rate. So in that context, a lot of burden has been captured. But at the same time, there are some near-term risks which we think may derail asset quality as well as the improvements to profitability that we have been anticipating for some time. So the near-term risks include obviously the topics that everyone is discussing, essentially the risk from the NBFC, HFC sector, the risk from real estate loans, and as well as the secondary order of highly leveraged promoters that may just derail asset quality improvements for banks and as well as at least delay improvements to profitability in the near future.
Okay, so we'll talk about real estate in just a bit, but I want to touch upon that promoter leverage that you were talking about. And where does India stack up in terms of private sector leverage risk in the APAC region?
Sure. So when it comes to private sector, the absolute amount of leverage in India is much lower than the other countries in the region. For instance, in India, the private sector leverage or private sector debt to GDP metric that we look at is about 50-odd%, whereas there are other countries, more highly levered countries like China, Hong Kong, or even the more advanced countries like Australia, Japan, where the absolute levels of leverage is much higher. Having said that, there are few nuances in India which create risk from the private sector leverage. So first of all, in India, the loans or the leverage is highly concentrated with certain corporate groups. And as we know, many of these corporate groups are highly leveraged, and which has led to asset quality issues for the banks in the past and is also resulting in new challenges for banks as we go along. So although the absolute level of leverage may not be as high as in the region, having said that, we do think that private sector leverage does pose risk to banks' asset quality in India.
Okay, so while that is not a very big issue, which is what we just spoke about, that's private sector leverage, where they are heavily exposed is the property sector. Now, will that continue to remain a pain point?
Sure. So on property sector, we do think that there are perhaps three areas of risk for the banks. So one is the direct property exposure of the banks, particularly to the real estate developers, because these developers are facing refinancing challenges. The second impact is the indirect exposure of banks to the real estate developers, and this is mainly via the bank's exposure to NBFC, HFCs, who directly lend to the real estate developer. And the third order impact is essentially when and if any of these projects get stalled, the impact to the borrowers who have bought properties and who are unable to get hold of that property, but then may not want to even service their loan. So we do think that the property sector exposure, the risks are quite imminent for the banks. And in that context, at least we do expect more new NPLs to come out from this sector.
Okay. All right. Let's talk about asset quality then. I know we briefly mentioned and touched upon it, but according to Moody's, do you feel that we're coming off the peak in terms of the NPA cycle, or do you think that there could be some further deterioration before the actual pickup happens?
Yes, on asset quality, on one hand, we talked about some of the risks, which include risk from NBFC, HFCs, real estate developers. We also expect that there will be a gradual uptake in retail asset quality or NPLs in the retail sector as well. Having said that, we do think that some of these risks may get mitigated by the resolutions that are taking place in the NCLT process. As such, overall, if I were to sum up, we do think that while on one hand there are risks, on the other hand there are some mitigants, and overall we think that the cleanup of the bank balance sheet will take longer than what we were anticipating perhaps a year or so ago.
There's another report that I read, and I want your view on that, is that NBFCs now, to start looking at overseas funding, to make sure that they get to tap funds at a better rate. Do you feel that is something that's an option for Indian players as well?
Sure. So there are many NBFCs or HFCs, perhaps put together NBFIs, Indian NBFIs, who have been tapping funds from international markets. Obviously, I think I can't comment on pricing decisions for these NBFCs, but one of the drivers for them to go to international market is also to diversify funding, and it is coming at a time when the Indian markets are very cautious about new lending to these companies. In some cases, but particularly the banks have reached a maximum limit of their exposure to their sector. So this is perhaps a diversification move also by some of these companies. But at the same time, we don't expect that the sector as a whole will be able to tap international markets. We do think that there will be selective companies that have good operating metrics to talk about. Those are the companies that may go and tap funds from international markets.
All right, so on a very selective basis, that could be an incremental positive for some of the larger NBFCs. Coming down to the other point in your report, which was regarding the increase in the prime age population, country-wise. And for India, it seems like there is a big potential to tap into that ever-growing customer pool, which is, that prime age population. How much of a positive are you seeing this to be from a long-term perspective?
Sure. So essentially, we do classify this changes in demographics as being one of the social risks that are emerging in many countries. There are countries within Asia Pacific that are rapidly aging, countries like Japan, Taiwan, Thailand, many countries in the region that are rapidly aging. And essentially in those markets, we do think that the customer pool is shrinking for the banks, and the banks are trying to compete with each other for those prime type of customers. And in some markets, we also see that the banks are going down the quality curve. On the other hand, in the case of India, obviously Indian banks or the Indian markets does offer a demographic dividend for some time, because India's population is expected to increase in the near term. And we do think that this growing population does offer more potential for banks to tap customers. The connectivity in India, perhaps the last mile connectivity is increasing. Technology is a big enabler. So we do think that those demographic changes are something that will positively benefit banks in the longer term.
All right. One last question, Alka, on this conversation. Another point that you make in your report is with regards to the competition that some of these banks are facing with regards to fintech firms in e-payments. What's your view on the same, and how do you think this plays out?
Sure. So this is one trend that globally we do expect that the competition or competitive intensity from new entrants in the banking system will increase across the region. Even in Asia Pacific, regulators are granting licenses to new challenger banks or digital banks in many countries. India has differentiated licenses for payment banks, for small finance banks. The NBFC sector in India is already quite large. And we do think that technology also has been a key enabler of the NBFC sector in India. So in that context, we do expect competitive intensity to increase in the region also specifically for Indian banks. Having said that, we do think that large incumbent banks who are quite agile themselves are spending a lot of money to improve their technological capabilities. We also think that the large banks have a funding advantage, they have a franchisee advantage, and banks that capture these advantages will thrive. On the other hand, we do think that banks that are laggard in making new investments or capturing these new changes in customer preferences also may eventually get disrupted by some of the new entrants in the markets.